I'd like to welcome everyone to Creation Business Consultants Tax Update. My name is Scott Cairns. I'm Managing Director of Creation Business Consultants. I'm joined by my colleague Stephen Ireland, who's our Head of Tax. As everyone would know, I'm sure, a bit of a bombshell last week from the UAE government that we're going to be facing corporate income tax in the coming years. So there are two certainties in life, death and taxes. So the second one is assured. What we're going to be doing today is Stephen will be giving an overview of tax that we understand as of today and doing some Q&A at the end. Now, we've turned off the Q&A for the presentation. What we'd like everyone to do is to use Slido. So if you haven't used it before, if you can just open up a browser on your phone and go to www.slido.com. And if you enter the hashtag creation tax, we'll be able to collate all of your questions there. And you can then, if you see another question that's similar to yours, you can vote on it. And there, that'll put your question towards the top so that we can address that at the end. So if you can also scan that QR code and that will take you directly into this. Okay, so we've got a few people. We might just wait another minute or two. I think we've got quite a few more people that were waiting to register. We've got a few messages there just logging in now. So give us about one more minute and we'll kick off. Okay, so we might kick off then. So I would like to introduce Stephen Ireland, our Head of Tax. Stephen has been in the region for more than 15 years. He's a tax professional with more than 20 years accounting, finance and tax experience. He has worked on M&A deals. He's lived in Saudi and the UAE for quite a while and dealt with taxes in both regions. And he's also got Big Four pedigree. So Stephen is very well placed to talk to you guys today about the new tax update. So I'll hand over to Stephen from here. Stephen, thank you very much.
Great. Thank you very much, Scott. Good afternoon, everyone. I hope everyone's well. Welcome to the webinar. I know a few of you are still working from home, so I hope this webinar will break the boredom. We have based our slides on the frequently asked questions published on the Ministry of Finance website. There are still a number of unknowns, but we will provide our initial views, which will hopefully answer some of your questions up front. Just to give you a bit of background about why corporate tax has been introduced. The UAE is a signatory to the OECD's global tax deal, which means that it must introduce corporate tax. Otherwise, there would be a risk that it would be added back to the EU blacklist again. The global tax deal is a measure designed to stop tax avoidance and tax evasion by global organisations. It's part of UAE's commitment to avoid harmful tax practices and decreases the risk of the UAE being seen as a tax haven. The effective date is the 1st of June 2023, but it's only relevant for accounting periods which start on or after that date. So for most businesses with a calendar year end, then they will be subject to corporate tax from the 1st of January 2024. So the OECD established the Base Erosion and Profit Shifting, or BEPS project, to address growing global concern over tax avoidance strategies to artificially shift profits to low or no tax jurisdictions. In 2017, the European Union Code of Conduct Group targeted countries with no or low tax. Following a review of the UAE tax framework by the EU, the UAE was initially added to the EU blacklist of non-cooperative tax havens in December 2017. In response to this, the UAE joined the OECD inclusive framework on BEPS and committed to meet the standards required by the EU, which led to it being removed from the EU blacklist. In 2019, the UAE introduced 2 of the 4 minimum standards of BEPS: economic substance regulations and country-by-country reporting. As mentioned on the previous slide, last year the UAE joined OECD's global tax deal to introduce a global minimum tax of 15% for multinational groups that have a consolidated global revenue in excess of 750 million euros. So it was exactly 1 week ago that the UAE Ministry of Finance announced the introduction of corporate tax. No legislation has been published yet, but it is expected to be released this summer. So as mentioned previously, this will come into effect from the 1st of June 2023. And the first corporate tax return filing is due in 2025. So businesses will be subject to a federal corporate tax, which will apply across all Emirates and will apply to businesses that are undertaking a trade or any kind of commercial activity in the country. The only exception is for businesses engaged in the extraction of natural resources, which will continue to be subject to Emirate-level corporate tax. Branches of foreign banks are currently subject to tax of 20% under their local Emirate-level tax decrees, but in future they will be taxed like other UAE entities. Individuals' income from employment, bank deposits, personal investments will not be taxable. If an individual is required to obtain a permit to carry out an activity, then they may be subject to corporate tax. So for example, if an individual owns a property and wants to list the property on, say, Airbnb in Dubai, then they must get a permit from the Department of Economy and Tourism. So this may mean that that individual will need to register for corporate tax. Foreign entities and individuals will be subject to UAE corporate tax if they conduct a trade or business in the UAE in an ongoing or regular manner. Yeah, and just a point on residence. So if you have a foreign company which is controlled in the UAE, then it will be subject to corporate tax in the UAE. So many UAE groups have their ultimate holding company in the BVI or Cayman. So that will mean that these companies could be subject to UAE corporate tax if they are controlled in the UAE. So just a bit about the free zones, because this is quite a common question that we're getting asked. It was originally thought that entities registered in the in the federal financial free zones, ADGM and DIFC will have preferential treatments, but they will be treated the same as all entities in the other emirate level free zones. So all free zone entities will be required to file a tax return. However, the UAE will continue to honour CT incentives currently offered to free zone companies, which is generally a 50-year, up to a 50-year tax holiday, provided they comply with regulatory requirements to do not conduct trade or business with mainland UAE. So free zone companies were created to allow 100% foreign ownership and are not allowed to trade within the UAE mainland. So conducting business on the mainland would mean that the entity would be subject to corporate tax. So if a company is in a free zone but operating like a mainland entity, then there may be no difference in the way corporate tax applies to it. Some free zones offer a dual license regime, which allow them to operate on mainland. So they will be operating within the regulatory requirements, but it just remains to be seen whether there will be any relaxation of the rules for these type of entities. The Ministry of Finance has confirmed that no withholding tax will apply on domestic and cross-border payments, and there will be no withholding tax on outbound dividends, interest, royalties, and other payments. The UAE will continue to be a very tax-efficient headquarter or holding company jurisdiction, given that it will also have a participation exemption, which means that no corporate tax will apply on dividend income and capital gains. So the UAE has signed 137 double tax treaties, 104 of which are currently in force. A double tax treaty generally reduces or eliminates withholding tax on foreign dividends, interest, capital gains, and other income from subsidiaries. We will continue to see a lot of multinational groups having their regional headquarters in the UAE, and this will cement UAE's position as a regional and international hub. As I mentioned earlier, many UAE groups have their ultimate holding company in the BVI or Cayman. There are economic substance regulations in the BVI and Cayman, which are similar to the regulations we have seen in the UAE. It's becoming difficult for groups to put substance in these countries. So what we are seeing in practice is that many of these groups are re-domiciling their BVI and Cayman entities into DIFC or ADGM. So the starting point for computing the taxable profits is the accounting net profit as reported in the financial statements prepared in accordance with international acceptable accounting standards. So for US or UK headquartered groups, it remains to be seen whether it will be acceptable to use US or UK GAAP, or will they need to be converted to IFRS. So when computing profits subject to tax, then you have to disallow certain items. So some examples include penalties for late filing, entertaining expenses, personal expenses, salaries paid to family members, disallowance of sponsorship fee paid to local shareholder, disallowance of excessive salary paid to director shareholders. Also, interest deductions are likely to be limited to between 10 or 30% of profits, in line with BEPS Action 4. Also, other related party expenses that are not on an arm's length basis will be added back. Finally, the tax law will specify the tax depreciation rates on different type of assets. So the depreciation per the accounts will be added back, and then there will be a deduction for the tax depreciation. I mentioned in the previous slide that the UAE will have a participation exemption. So capital gains and capital gains and dividends received by UAE businesses from qualifying shareholdings will be exempt. So what does qualifying shareholding mean? So many European countries have similar participation exemptions, and to qualify, you will need to hold at least 5% of the shares in the resident or non-resident subsidiaries. And usually these subsidiaries will need to be held for the minimum period of, say, 1 or 2 years. There will also be exemptions for qualifying intragroup transactions and restructurings. So what are qualifying intragroup transactions? This refers to the fiscal consolidation regime. So similar to what we've seen in a back group, intragroup transactions will be disregarded if a group tax return is filed for all the UAE entities. Qualifying share restructurings means that if a UAE group company or asset is transferred to another group company, then there should be no corporate tax on any capital gain. Finally, there are no special exemptions for UAE or GCC nationals like we have seen in other GCC countries such as Kuwait, Qatar, Saudi Arabia. So moving on to tax losses. So tax losses can be carried forward and offset against taxable profits in future years. The results of the year will be driven by the financial statements of the previous year. So if an entity is expected to incur losses in the first period or is an asset-intensive business, then I would say it's very important that the entity is subject to a financial audit during the previous year, so there can be at least some certainty on the closing balances in 2023, and losses in 2024 can be offset against profits in future years. You don't want to be getting into disputes with the FTA in a few years down the line when you utilise the losses and the FTA are arguing that they are not available. There is a possibility to create a tax unity of UAE-based entities under common ownership or control. The group will be treated as a single tax entity and may file a single tax return. Where UAE businesses are part of the same tax group, then the losses of one group entity can be offset against the taxable profits of another group entity. So the minimum ownership requirements for group relief would typically range between 75% and 100%. So I can imagine many large groups which have many UAE entities would consider this as a benefit. However, there may be challenges with the 51-49% shareholding structures and entities where the legal and economic ownership is different. So they may not qualify to be part of the same tax group. So just moving on to the rates. So there is a 3-tier rate. So first of all, you have an exempt threshold if you're earning taxable income up to 375,000 dirhams, which is approximately $100,000. Taxable income above that amount will be subject to a 9% corporate tax rate. So if you ignore the country with no corporate tax, then this will leave the UAE with the lowest global corporate tax rate alongside Hungary and Montenegro, who share a corporate tax rate of 9%. All of the GCC countries except for Bahrain already have a corporate tax system. Qatar has a corporate tax rate of 10%, Kuwait and Oman have a tax rate of 15%, and Saudi Arabia has a tax rate of 20%. So if you ignore Bahrain, then it will still be the lowest tax rate in the Middle East region. If you take into account additional exemptions, the effective tax rate could well be below the statutory rate of 9%. Finally, there is an additional tax rate of 15% for large multinationals, which has followed the UAE's commitment to global minimum tax. By having this provision in the tax law, then it should stop other countries from taxing UAE businesses in the future. So foreign tax credits. Currently, foreign tax credit applies restrictively only to foreign corporate tax paid. However, we also expect there to be credit for foreign withholding tax. I mean, this will be great news for UAE companies which receive income that has been subject to foreign withholding tax, as it should be possible to offset the withholding tax against its corporate tax liability. So moving on to transfer pricing. So what is transfer pricing? This is a process used to set prices where one related party supplies goods or services to other related parties in order to ensure that correct quantum of profits is attributed to each party to the transaction. It's only applicable to transactions between related parties. For example, entities within the same group or entities with common ownership. Transfer pricing is important also from a customs duty perspective. For example, if the pricing of goods from another country is too low, then this will result in an increase in the customs duty liability on the importation of goods into the UAE. I suspect there will be a lot more information sharing between the FTA and customs authorities in the future, and I suspect that we will eventually see a merger between the FTA and the customs authorities in the near future, just like we have seen in KSA. I believe that small companies with limited related party transactions will be exempt from transfer pricing requirements. So moving on to the administration, you've already seen the FTA website being updated for corporate tax registration. So will all entities that are registered for VAT automatically be registered for corporate tax? We have seen something similar in Saudi Arabia, where existing registered entities which were registered for corporate tax purposes were automatically registered for VAT purposes. There are no provisional or advanced corporate tax filings or advanced tax payable. However, I believe that at some point in the future, large taxpayers will be required to make quarterly payments. It remains to be seen whether the UAE will scrap the economic substance regulations. We have seen Qatar introduce economic substance regulations last year, which are applicable to entities registered in their financial free zones. So we may see the UAE following the same approach. Finally, will financial statements be required to be submitted with a tax return, just like you see with some jurisdictions across the Middle East? So there were a lot of lessons learned here in the country following the introduction of VAT in 2018. So the UAE has given us plenty of time to prepare for this corporate tax. So what we would strongly recommend that you don't wait until the legislation is released before carrying out an initial impact assessment. So this assessment should just be done as soon as possible. This will help you to identify the high impact areas which you can start focusing on now, so that you're ready to restructure when the actual law comes in. As I mentioned earlier, it's important to understand which accounting standards you will follow for UAE accounting purposes. So many entities on mainland have not been preparing any financial statements, so it's very important for those entities to start preparing financial statements for the current year. We've already seen mainland businesses, that operate purely on mainland, looking to set up in a free zone, especially if they've already got customers there, or if they've got international customers, then it would probably make sense then for them to look at that. So yeah, I've already mentioned it's important to maintain proper financial statements. Along with that, it's also possible, we would also recommend you maintain a fixed asset register so that you can reconcile between the tax base and the accounting base. Yeah, finally, I mean, this can be done probably at a later stage, but we would recommend, especially those medium or large businesses, if you haven't already got transfer pricing documentation in place, then you start to prepare that documentation. So the key takeaways then, so corporate tax will be applicable to all UAE entities, including free zone entities, but the UAE should continue to respect the free zone holidays if they operate just within the free zone or with international clients. So there's a 9% corporate tax rate, which is the lowest globally, and also the lowest in the Middle East. There's no withholding tax on outbound dividends, interest, royalties, and other payments. There's an exemption for dividends and capital gains received from qualifying shareholdings. Also, foreign tax will be allowed to be credited against the UAE corporate tax payable. And finally, the first tax return period for most companies will be the year ending 31st of December 2024. So, as I mentioned earlier, there's a lot of work which needs to be done between now and the 1st of June 2023. So we would recommend that you carry out the initial impact assessment as soon as possible. I'm just a bit conscious of time now, so I'll just move on to the Q&A. And I'll do my best to answer any questions, but feel free to reach out to me directly if you have any further questions once the webinar has been concluded.
Okay, so thanks, Stephen. Obviously, there's a lot of information there, and not long to get ready, I think, is one of the key takeaways from this. We're just going to pull up the slide with Slido. So if people want to ask questions, just to recap, you can scan this code, this QR code, and punch your question in there. Have a look at the other questions. We've already got a lot of questions on there, and we'll run through them. So in no particular order, other than the most popular, Stephen, so for free zone companies, will corporate tax be applicable on all revenue or just the revenue coming from mainland?
Yeah, I mean, that's like the number one question we're getting at the moment. So yeah, it just remains to be seen whether a few transactions with mainland entities will disqualify you from benefiting from the tax holiday that's available in the free zone. or will there be some sort of pro-ratering where just those invoices addressed to mainland UAE entities will be subject to corporate tax? So yeah, that's we still need further clarification around that.
Yeah, I think that's a wait and see once we get a little bit more guidance from the FTA on that one. We have, will a permanent establishment be taxable in the UAE?
Yeah, so if you've got a foreign company that's operating in the UAE, well, generally you'd have to be licensed to do business in the UAE. They'd have to be licensed, and then so you probably have to register a legal presence, and then that will trigger a corporate tax filing. Then, so the answer to your question is yes.
But I guess that's also for people from overseas doing business here without an incorporated entity. They better be aware that the FTA probably will start looking for them in the future, because there's a reason to look for them.
Yeah.
Yeah. Okay. Would companies that own UAE real estate be subject to tax, and would mortgage interest relief apply? Rather specific.
Yeah, well, basically, I mean, we unfortunately don't have the detailed regulations, and the law. So, but based on my experience, yeah, if you've got a company that owns real estate, yeah, then that rental income will be subject to corporate tax. And if you want my view on deductibility of interest, then I believe there will be a deduction available, but it just needs to be, well, if it's with a third-party bank, then you'd expect a full deduction to be available. But if it's from a related party, like I mentioned earlier, there may be some restriction in the interest.
Okay. Okay, so cash or accrual basis. So we've got a question on taxes are usually on a cash basis and books are maintained on an accrual basis for IFRS. How would you reconcile those? So which do you think the taxes will be based on, cash or accrual basis?
On accruals basis, and I think it's something that the companies are going to have to look at, because previously they were not used to including any tax provisions in the financial statements, but they will now need to include a corporate tax provision, a deferred tax provision, after considering timing differences and permanent differences. So yeah, and that will be on, these provisions will be on an accruals basis.
And I think that's going to be a big one too. People actually, as you mentioned earlier, having to prepare accurate financial statements in accordance with actual accounting standards will be a big change for a lot of businesses who probably haven't done so to date. Yeah,
agreed. And yeah, those listed companies as well, they'll be required to prepare quarterly financial statements. So in those statements, you'll need to compute the corporate tax provision and deferred tax.
Will free zones have to pay taxes for profit accrued from offering services to clients outside of the UAE? I think that goes back to your answer earlier.
Yeah, I mean, if the entity is dealing with only international customers and clients, then yeah, I mean, there should be the entity should be able to continue to benefit from the 50-year tax holiday or whatever it is.
Okay, we've obviously got someone from the construction industry. How will bad debt provisions be treated for tax purposes?
Again, we don't have the detail yet, but based on my experience in other jurisdictions, if you've got a specific provision against a bad debt, then generally that will be taken into account. But where you've got just a general bad debt provision, so if it's a policy to provide against all age debtors over, say, 6 months. That will be a general provision. And then what I've seen in European jurisdictions, then this general provision is basically disallowed. So it's only specific provisions for debts that will be an allowable deduction.
Yeah. Here's a good question. Will all businesses need to get their accounts audited? So I guess the first part, just for me to jump in quickly, is the commercial companies law has always said that mainland companies especially needed to prepare accounts. A lot of free zones do require audited accounts to be lodged, especially in Dubai. But what's your take on it now with the new tax regime?
Yeah, I mean, I believe that, I mean, there may be some, like we see in the UK, there may be some exemptions from audit requirements for small companies. But like I mentioned earlier, it's very important now to companies start preparing proper accounts, and to give you more comfort that they've been prepared in accordance with international accounting standards. Then we always recommend, it's always best practice for for those financial statements then to be subject to an audit, because then you just got a bit more certainty then, and because that's very important. Like I mentioned earlier, the starting point for preparing a corporate tax computation is the profit per the financial statement. So it's very important that you get that right. Otherwise, you may have issues with the FTA later on down the line, because they have become more sophisticated after the introduction of VAT in 2018. So, rather than, I mean, we're only just recently seeing VAT audits, but I think on the corporate tax side, given that they've really recruited heavily in the last few years, then I suspect you're going to see audits. We won't be waiting for 3 years to see the first audit. It's going to be conducted within the first couple of years. So yeah.
And I think also too, on the preparation of the accounts, I think we're going to see a lot of the large sort of older family businesses, the ones that have sort of grown organically over time. They're going to have a hell of a time trying to pull apart their individual businesses to basically take out individual expenses and personal expenses, personal assets, and actually start building them into tax, I guess, groupable areas. Because I've seen some company groups that are very intertwined with family investments and personal investments and a lot of personal expenses. So I think there's going to be a lot of work to be done even before we get to the taxes, just to get their accounts cleaned up. Yeah,
agreed. And also what we see with family groups, they've often got a large number of UAE entities. Some of those are dormant. So it probably makes sense for some sort of entity rationalisation. So it's one less company then to worry about, because if for some reason you don't file a group tax return and each entity files corporate taxes on an individual basis, which could happen with some family groups because of the different shareholdings, then it would make sense to rationalise those entities and start liquidating some of those entities before the go live date.
Another question here: what documentation will be required for transfer pricing?
So in line with global standards, so local file, master file, whether they actually have to be submitted to the FTA remains to be seen. But what we see in other jurisdictions in the Middle East is that the tax authorities could request this transfer pricing documentation anytime, and then we've got to make that available within, say, 30 days, a very short period. I mean, it normally takes you over 30 days to prepare this documentation. So again, it's always good practice to make sure you have this transfer pricing documented documentation in place, so it's ready to share with the tax authorities. So if you're able to share it straight away with the tax authorities, then more often than not, then the tax authorities think you've got your books in order, and more often than not will just go away. So yeah.
Is withholding tax applicable to management fees or consulting services?
Yeah, I mean, it depends. If you're talking about outbound, then no, there is no withholding tax on any management fees or any other payments made outside of the UAE.
Okay. Yet.
Yes. Oh, yes. I was going to say, yeah, that could be the next big.
Devil's in the detail with this, so who knows what will come in the future. But for the moment, there's no withholding tax being announced.
Yeah, you're right, Scott. You expect withholding taxes to be the next tax to be introduced, which is in line with the other jurisdictions within the Middle East.
Yeah. So, but back on the transfer pricing and the ESR, do we need to take precautions for related party transactions?
Yes, definitely. Like mentioned earlier, it's only transactions that are being done on an arm's length basis will be an allowable deduction for tax purposes. So it makes sense now just to make sure all the pricing is on an arm's length basis, so you don't have to worry about that additional adjustment when it comes to filing your tax return.
Mm-hmm. Will there be a separate registration requirement for all businesses within the scope of corporate tax, or do they need to register for corporate tax only if tax is payable?
No, so all entities, even in the free zones, will need to register for corporate tax. Whether they end up paying any taxes, it depends on their transactions. So if it's all international transactions or within the same free zone or with customers in other free zones, then they should continue to benefit from a tax holiday, in which case you'll just be filing a nil return.
Okay. All right, we're just about out of time now. So, Stephen, so any final words of wisdom or encouragement to, soften the blow for everyone who's now been living tax-free for such a long time and is now staring down the barrel of being genuine taxpayers?
Yeah, I mean, it's nothing. The UAE has given us plenty of time to prepare for this, so I don't think there's need to panic. There is plenty of time, but yeah, I mean, the sensible thing will, like I mentioned earlier, just to we've got a lot of information already, so it does definitely make sense to at least conduct initial impact assessment, and then once the law and regulations have been released, then you can then tweak, update that impact assessment report, and if necessary, start restructuring your group. So, in terms of restructuring, I'd say that's definitely important to start as soon as the legislation is released, because that is quite a time-consuming process if you're opening companies, liquidating companies. So, yeah. Yeah,
and I'd say my 2 cents on this too is there is going to be a mad rush towards the end. We all saw it with ESR and VAT. So I would suggest that people, where possible, do start thinking about this sooner rather than later, and definitely do not leave it to the last minute, because people will be harder to find to assist you. And if there's any changes that need to be made, I think changes sooner rather than later would be a wiser choice. So, all right, well, I think that's it from us. I'd like to say a big thank you to Stephen. That was fantastic, very informative and educational, and well done on the Q&A. I know there were some good questions in there. If anyone there has any questions that they would like to shoot across, you can book an appointment with Stephen and have a quick chat to him or myself, and we'll see how we can help. This is obviously only the first part of the information that we have regarding corporate tax. So we will be providing regular updates where we can. So we'll try and keep them short and punchy. We'll try and answer people's questions as and when we can. And as we get in more information, you'll be hearing more from Stephen helping people out. So I'd like to thank you all for joining today and wish everyone a great afternoon. Thanks, guys.
Thanks, everyone. Have a great day.
Cheers.